Hello, ladies and gentlemen. My name is Lars Schall, and on behalf of Matterhorn Asset Management in Zurich, Switzerland, I welcome you to the second part of the special interview series that I conduct with Mr. F. William Engdahl. Mr. Engdahl, in the first interview, we talked a little bit about the Asian pivot. Now let's talk about Asia and its appetite for physical gold and precious metals in general. Do you think, or what are your thoughts on the wealth transfer that's going on in physical precious metals from the West towards the East?
In the last several years, there's been a marked trend. Previously, it was the Indian gold market for physical gold, jewelry for weddings and so forth, that was driving much of the gold market in terms of physical gold. And in the last years, it's become the Chinese, both private consumers, but also the People's Bank of China, the Central Bank of China. And I think that goes parallel with the fact that more and more central banks around the world, especially in the East, where the economies are the locomotive of world economic growth in the last 10 years, not in the West. The U.S. is not a locomotive anymore since a number of years. They realize that the dollar that they invested their trade surplus in is becoming more and more endangered. And not only that, but with the euro crisis, there's not a euro as an alternative to the dollar as a solid, safe currency to buy state bonds of the eurozone countries like Greece or Portugal, Spain or Italy or what will you. So the trend, and it's a marked trend, is from the central banks of Eurasia, and I would include Russia in that as well. They are stocking up. They're very shrewd players in the market, so when there's a collapse in the price of gold because J.P. Morgan Chase, in connivance with the Fed, as they did recently in April, go with naked shorts in a volume that's just unbelievable unless you were backed by a central bank like the Fed, in order to create a crash in the price of gold and take the shine off its attraction. But the Bank of China buys on the dip. They understand that physical gold in the long term as a backing to a convertible renminbi is going to make that convertibility far more credible when it happens, and the possibility that the renminbi eventually would become a reserve currency for other central banks. So that I think that is the main driver in terms of physical demand for physical gold in the central banks of Asia.
What percentage do you think do the Chinese need as part of their currency reserves in gold?
Well, there are benchmarks that are used historically. Now it's well under 10%, the latest numbers that I saw in terms of that. Russia, the same. The Russian central bank has rather tiny gold backing for its currency, also well under 10%, I think 2-3%. So 10, somewhere in the range, perhaps even 15% gold backing, I think would be a much more comfortable zone for these central banks in Asia. And that means huge consumption of physical gold off of the market in the next years.
Mm. Do you think that the Western central banks do actually have the gold that they claim they have?
Well, I know because it's been publicly admitted that the Bundesbank doesn't have the Bundesbank gold that they thought they had, because it's sitting in the vaults of the New York Fed, if it's even still there. Mm-hmm. It's been a mystery. I've talked with many precious metal experts and analysts of the gold market from Deutsche Bank and others over the years, and it's an open question whether, since the Nixon declaration that the Bretton Woods agreement on the dollar being backed by gold and redeemable in gold from other central banks, since that was ripped to shreds by Nixon in August of 1971, and the dollar went to a free float or a dirty float, depending, then since that time, it's been a genuine question: what are the true reserves on hand that belong with title to the Federal Reserve or the United States Treasury? And nobody knows. Yeah. Nobody knows. There's even This is very difficult to confirm, but shortly before his expose for a sexual escapade with a maid in a hotel in New York, that the head of the International Monetary Fund, Dominic Strauss-Kahn, a couple of years ago, was demanding a full accounting of the gold reserves of the largest voting power of the IMF, namely the United States. And to my knowledge, that hasn't been done.
No, there hasn't been an audit since 1954. These were the days of Dwight D. Eisenhower.
Yeah.
Yeah. Would you say that it's good for Germany to leave half of its gold outside of Germany in London and New York?
If I were the Bundesbank and I were the German government and had the power to get that back, which by law they certainly do, I would get it back as soon as possible. The sooner the better, because once a dollar crisis erupts, and that's a matter of time, it's a ticking time bomb, given all the emission of paper that the Fed has been doing the last, since 2007 really, then the difficulty in getting that gold back is going to increase dramatically.
Is the gold market a free market or is it a rigged market?
Well, I have to laugh. The gold market, well, let's look at what drives the gold market. There's physical demand, which is increasing with every increase of the public debt of the United States government or the public debt of the Euroland governments. The physical demand for gold is there, and has been for a number of years, increasingly, and yet the gold price hovers in a certain range. What would happen were the gold price to be in a fair and an open market, a transparent market, without any naked shorts allowed to affect the price of gold futures? My guess is that the gold price would have skyrocketed in the direction of $10,000 per fine ounce 2 or 3 years ago even. It hasn't, and it's hovered in a trading range. Every time it starts to get into a breakout phase, there is something very bizarre and unexpected that happens in the gold market to put a brake on that. So these are not free markets. It's been documented that the decision in April of this year, 2013, to take out naked short contracts on gold in a volume that is simply cannot be done by a private risk-taking institution unless they had the full backing of a central bank like the Fed. That was an example of this manipulation of the gold market. J.P. Morgan Chase has been documented by Gatta and other analysts of the gold market for years as playing a sweetheart role in gold derivatives to help the Fed along. Because once confidence in the dollar breaks and the rush toward gold, which it does historically in any major financial crisis over centuries, once that begins, the role of the dollar as reserve currency is finito. It's over.
Yeah. What are your long-term expectations for physical gold?
Long-term, I think expectations for physical gold are enormously optimistic. I'm personally convinced of that, enough that my own investments have followed that conviction. But the long-term perspective for gold and silver is positive. The demand is higher than the supply, the physical supply, as long as you can get your hands on the physical precious metals.
Yeah. And related to silver, is it of interest that the stocks that central banks have in silver are basically zero compared to gold? And what does this tell you for the performance in the future of silver? Will it outperform gold? Well,
I've been expecting silver to outperform gold since about 2008 because simply historically it's way underpriced in relation to gold. But conveniently, at just the points where it seems like it's about to come into a more historically true relationship with the price of gold, something happens in the silver market and the price collapses again, as it did in the last months. So ultimately, in a true market, I'll call it a true market, not that there is no such thing as a free market, but in a true market, the price of silver should rise enormously with much more multiplier than that of gold.
Okay, thank you. Ladies and gentlemen, this was the second part of a 3-part series of interviews that I conduct with Mr. F. William Engdahl. Goodbye.